Good morning, everyone, and welcome to our weekly macro and strategy update. Federal Reserve members will meet this Wednesday to discuss the monetary policy stance in the US. The stronger economic outlook will be reflected in the committee projections for 2021. GDP growth will be revised upwards to more than 6%, while the other forecasts for the next 2 years are likely to be little changed. Given the rise in long-term yields, Fed Chair Powell will certainly be asked about the possible operation twist. But what is meant by operation twist? Let's look first at the numbers. Fed security holdings are huge, close to $7,000 billion, a third of US GDP. In particular, it holds $330 billion of Treasury bills that mature in less than 1 year, and $4,300 billion of Treasury notes and bonds. The average duration of its Treasury holdings is around 6. To respond to the steepening of the yield curve without increasing the amount of the QE program, the Fed could decide to extend the duration of its purchases or to substitute short-dated for long-dated Treasuries. That is to say, selling T-bills and buying T-notes and T-bonds. This policy is aimed to limit the rise of long-term interest rates. This is what we call Operation Twist, an operation that was implemented for the first time in the 1960s, but with a slightly different purpose. While the Fed could use one of these tools if financial conditions were to tighten more than expected, we do not expect the Fed to implement them in the near future. Rather than the level of interest rates, we think that it is an acceleration of the speed of the normalization that could be a risk for markets. Thank you for listening, and see you next week.